evening, ladies and gentlemen, especially unit holders of ALOG. Welcome to the SIAS-ARA virtual dialogue session. We have this evening sharing with us the CEO of ALOG, Karen Lee, and we have the CEO of ESR REIT, Adrian Chui, on the panel with us this evening. Today, both Karen and Adrian will be sharing with you the details of the proposed merger, and we'll be glad to take questions from the floor after the presentation. And with that, over to you, Karen.
Thank you, Wan Chen. Good evening, everyone. I would like to thank SIAS for hosting this virtual dialogue, and thanks, Adrian, for joining me this evening. And a very big thank you to our unit holders for taking time to join us today. It's been 3 months since we last announced the proposed merger between ALOG and ESR REIT. Allow me to take the next 15 minutes to recap and walk you through the key rationale for this transaction and why this merger will be transformational and value-creating for our unit holders. Let's start with the most important reason why we are proposing this merger, that is, scale and growth. The enlarged REIT will be known as ESR LOGOS REIT or ELOG. Post-merger, ALOG will leapfrog from a mid-cap REIT to a top 10 S-REIT by free float, creating a benchmark new economy REIT with a supercharged growth trajectory sponsored by the ESR Group, which will soon complete its acquisition of ARA. The creation of ELOG provides it access to a new economy pipeline of over 50 billion, of which 2 billion are immediately actionable. The merger would also remove any potential overlapping mandates between ALOG and ESR REIT. ESR REIT, an established SGX-listed REIT, invests in quality income-producing industrial properties. With a total asset base of 3.4 billion, ESR REIT has a diversified portfolio of 58 properties located across Singapore, and also 10% interest in ESR Australia Logistics Partnership, a private fund comprising 36 predominantly freehold logistics properties, all located in Australia. ELOG will continue to be managed by the ESR Group, including LOGOS, and ALOG management team will also be rolling over to the new platform. The proposed merger will be effected by way of a trust scheme of arrangement, where for every ALOG unit you own, you will receive a bundle comprising of 1.6765 new ESR REIT units and 9.5 Singapore cents in cash. As you'll be swapping the majority of your ALOG units for ESR REIT's units, the proposed merger will allow you to roll over into an enlarged REIT and remain vested in a larger platform in a DPU and NAV accretive transaction. We believe you will be able to enjoy the upside of this merger as our growth trajectory will be enhanced, while you will also be able to crystallize part of your investment returns in cash. Back in April 2020, following the entry of a new sponsor, LOGOS, and the rebranding of Cash Logistics Trust to ARA LOGOS Logistics Trust, we swiftly and successfully executed our portfolio rebalancing and growth strategy. This included the acquisition of a 400 million Australian portfolio from LOGOS, divestment of 2 low-yielding assets, and several defensive AEI works. This delivered a 45% increase in total assets and an 18% increase in NAV per unit. This strategy delivered tangible returns to our unit holders, as evidenced in the outperformance of unit price of over 79% and superior total returns of over 100% as compared to our peers. In September 2021, ALOG was also included in the FTSE EPRA Nareit Index, a leading real estate benchmark which tracks the performance of listed real estate companies and REITs. This inclusion has further enhanced our visibility amongst institutional investors, driving re-rating and higher trading liquidity. I think we have done well since our rebranding. I would like to thank our unit holders for giving us your strong support and allowing us to execute our portfolio rebalancing and growth strategy. and the result is a strong 79% increase in our unit price. But we are not stopping here. We are constantly thinking of how to take A-Log to even greater heights and to deliver stronger growth in a sustainable manner for you. Our growth and enhanced trading liquidity in the last 12 months triggered a strong re-rating for A-Log. This positions us well for our next transformational transaction, which will further allow us to leverage on the tailwinds supporting our strong performance last year, being growth, scale, and liquidity. Through this merger, the enlarged platform will almost triple A-Log's current size. The new ESR LOGOS REIT will become the benchmark new economy APAC S-REIT with transformational scale. E-Log will be the 9th largest S-REIT by free float with a total asset base of over 5.4 billion, comprising 87 properties across diversified sectors such as logistics, high specs, general industrial, and business parks. You can see on this slide that 65% of E-Log's portfolio composition will still comprise of new economy assets, which is currently in strong demand. The rapid expansion of e-commerce, digital transformation, and rapid development of technology companies have continued to drive strong appetite for such new economy assets. And E-Log is in the right sector and will be able to ride on this growth. E-Log will be managed by the enlarged ESR group, including LOGOS, and will have access to more than 50 billion new economy AUM and more than 10 billion development work in progress pipeline. Our core focus in the new economy sector will continue to be further enhanced, providing outsized exposure to the largest secular growth opportunity in APAC, and this will propel E-Log's growth trajectory moving forward. Just to highlight, out of this strong pipeline, the sponsor is making available to E-Log, almost 2 billion is visible and actionable in the next 12 to 24 months, supercharging its growth. Most importantly, E-Log will be ESR Group's future-proofed flagship REIT with clear growth trajectory underpinned by our ability to access ESR Group's global network. There are 5 key immediate benefits of the proposed merger which we believe are compelling to our A-Log unit holders. I will quickly outline the 5 key benefits and will discuss them in detail in the subsequent slides. Firstly, the deal delivers immediate value accretion to A-Log unit holders with a 8.2% DPU accretion and a 2.2% NAV accretion. E-Log will have a superior combined operating platform and network sponsored by ESR Group, the most powerful new economy real estate platform in Asia Pacific. Our growth trajectory will be transformed and supercharged. We will now have access to more than 50 billion of our sponsor's new economy pipeline and 10 billion work in progress development pipeline. Being a top 10 S-REIT by free float, our enlarged scale positions us well to attract additional institutional investors, driving liquidity and potential re-rating. Last but not least, the enlarged REIT will also be more resilient, providing us greater scale, flexibility, access to more competitive pool of capital, and enhanced ESG offerings. Let's now look at more details in each of the key benefits I've just outlined earlier. First and foremost, the proposed merger is immediately value accretive to A-Log unit holders. Based on our pro forma FY 2020 results, post-merger, A-Log unit holders will see a DPU accretion of 8.2% and a NAV accretion of 2.2%. The mentioned numbers have accounted for corporate actions such as acquisitions, divestments, as well as lower financing costs due to the replacement of A-Log's current debt. The numbers have also taken in relevant transaction costs, savings from voluntary debt-funded payment of JTC upfront land premium for A-Log Singapore properties. It is important to note that this transaction is one of the highest DPU accretion amongst completed S-REIT mergers. I would also like to emphasize that while the DPU accretion is immediate, the potential upside has not been factored in yet, and we will quickly get down to work to execute the growth plan to deliver long-term sustainable returns to our unit holders. Another compelling benefit is that ELOG will be sponsored by the enlarged ESR group, including LOGOS, the largest and fastest growing platform with over 130 billion AUM. With a logistics DNA empowered by its new economy focus, the enlarged REIT will stand to benefit from accessing ESR Group's sizable new economy pipeline and leverage on its enlarged operational expertise, scale, and tenant network. In addition, ELOG will be able to tap into the sponsor's capital commitment and access to multiple capital sources. We can leverage on their deal sourcing network and explore partnership opportunities for new acquisitions. Having a big and strong sponsor is essential for a REIT's growth, especially one who is aligned with unitholders' interests to deliver sustainable returns and also supercharge ELOG's growth moving forward. Let me also provide you with more color on our sponsor, ESR Group. ESR Group has a strong track record with leading operating capabilities in key markets and a staff strength of over 2,000 employees. ELOG will be able to leverage on the enlarged ESR Group's local presence, its global tenant network, in particular e-commerce and 3PL companies, and de-risk new market entry if ELOG decides to expand into some of these new markets. Hence, beyond our current footprints in Singapore and Australia, we will be able to access other attractive markets such as Japan and China, where our sponsor has the largest pipelines. With a new economy focus, ESR Group's integrated business model across owner, developer, asset and investments are strengths which the enlarged REIT can rely on. The next two slides will emphasize on the importance of having a strong and quality sponsor. The proposed merger will remove any potential overlapping mandates between the two REITs. With ESR Group's sponsorship, the enlarged REIT will be able to access more than 50 billion new economy and 10 billion development pipeline, the largest pipeline from a S-REIT sponsor. Given ESR Group's leading market presence across APAC, the pipeline is well diversified across key markets such as Australia, China, Japan, and the rest of Southeast Asia, which have benefited greatly from the growth of the logistics sector due to the pandemic. Quality logistics assets are becoming increasingly scarce given the competitive landscape. ELOG can comfortably tap on the sponsor's strong pipeline for its growth moving forward. Both ELOG and ESR REIT's current sponsors have also demonstrated their commitment to grow the two REITs via divesting sponsors' assets to the REITs. Beyond such asset injections, both sponsors have also shown their commitment to grow the REITs and alignment of interest with unit holders by providing capital support in the equity fundraisings for various acquisitions. The enlarged ESR Group will continue its commitment to grow with ELOG to deliver quality growth, value creation, and long-term sustainable returns to all unit holders. The enlarged portfolio also comes with embedded organic growth. There are various ongoing AEIs within the ESR REIT's portfolio, such as increasing GFA and tapping on underutilized plot ratio, which will lead to organic growth. These AEIs are fully funded, but the organic upside from these AEIs have not been accounted for in the DPU accretion. Likewise, we can further improve the value of our portfolio with the implementation of rooftop solar energy generation by leveraging on the LOGOS NG Solar JV. These embedded organic growth opportunities will continue to provide further upside beyond the immediate day one DPU accretion. Once the merger is completed, ELOG will be the 9th largest S-REIT by free float, leapfrogging ELOG into the large cap S-REITs universe immediately, without any equity call from unit holders in a DPU and NAV accretive transaction. Further, this quantum leap will also improve our cost of capital, positioning us well to undertake even more sizable transactions. We will have access to our sponsors' large new economy pipeline. With an improved capital cost structure post-merger, we are confident of delivering sustainable value for our unit holders. With an increase in free float and being larger in size, ELOG is well positioned to benefit from a potentially larger weightage in the FTSE Nareit Index, larger institutional investor base, increased analyst coverage, and drive further index inclusion. The quantum leap in scale will surely drive increased institutional interest, which could potentially lead to a re-rating. One of the key transaction features is to unencumber all of ALOG's debt, and this will not only improve capital structure, but allow us to access more diversified capital sources and strengthen our position to obtain good investment-grade credit rating should we choose to pursue it. Such benefits are immediate and tangible to the REIT. The increase in funding flexibility and more competitive cost of debt will enhance our ability to deliver accretive supercharged growth. This slide will clearly demonstrate why size does matter. An enlarged platform will enhance ELOG's flexibility and ability to drive growth. Our 5.4 billion platform of 87 properties with 2.2 million square meters of NLA will now serve a combined 437 tenants. The enlarged REIT is almost 3 times of ALOG's current size and twice the size of ESR REIT. This immediately and directly enlarges ELOG's development and debt headroom, giving the REIT more flexibility and allowing it to increase its capacity to acquire more sizable assets and undertake larger AEIs and development projects. The enlarged scale also provides ELOG with greater flexibility for active capital management or deployment and asset recycling through portfolio rebalancing. This will help ELOG to strengthen its portfolio resilience by acquiring more new economy assets and divesting low-yielding assets. And we are very confident that this will drive its long-term growth. ELOG is expected to benefit from a combined pool of high-quality tenants, enhancing our tenant quality and diversification. With the enlarged tenant base across a wide range of industries, no single tenant will account for more than 5% of gross rental income or GRI. This will reduce tenant concentration risk and improve its defensiveness, and the portfolio's cash flow will be more stable as a result. The merger will further propel ELOG's ESG offerings with continued commitments towards sustainable operations and responsible investments. ELOG will also continue to proactively pursue ESG initiatives, including carbon footprint reduction, strengthening of green funding sources, and active community involvement. Both ALOG and ESR REIT have continued to demonstrate commitment towards achieving ESG excellence and upholding high standards of corporate governance. I've now come to the end of the presentation. Before we go into Q&A, I would like to just quickly highlight the views of the independent financial advisor who has opined that the financial terms of the scheme are fair and reasonable. Details of the IFA opinion can be found in Appendix B of the scheme document. Also, our independent directors have carefully reviewed and opined that the resolutions put forth at the upcoming EGM would be beneficial to ALOG. Finally, we hope that this presentation will provide a good overview of the key benefits of the merger and how we envisage that enlarged REIT will grow with the advantage of a larger scale because size does matter. We will have more flexibility and opportunities to do larger transactions and also access more competitive cost of capital to drive growth. This is not a proposition for ALOG unit holders to sell out, but roll over to the enlarged REIT that comes with a clear growth strategy. We hope our unit holders will continue to support us and participate in this growth journey with ELOG. Adrian and I will bring together a combined set of unique chemistry and skill sets to the new ELOG. We strongly believe in the merits of this merger and will work closely hand in hand to drive the growth of the enlarged REIT together with our sponsor and, most importantly, with our unit holders' support. And we look forward to your continuing support at the upcoming EGM and scheme meeting on 27 January. Thank you. Wan Chen.
Thanks very much, Karen, for that passionate and detailed presentation. Yesterday at the ESR REIT presentation, Adrian, CEO, talked about size does matter. And Karen, you've echoed the same sentiments. But you also brought up the point about the combination, the merger being transformational, being supercharged. I like those words. Those are very powerful words. So maybe Karen can take with us from the top, the tone at the top. What does transformational and supercharged mean to you?
Right. Thanks, Wan Chen. That's a good question. From the current ALOG's perspective, from the past 12 to 18 months, we have delivered strong returns for ALOG. But at the current present moment, as we know that ALOG is currently about 2 billion, there's certain limitation on the size, how quickly and how fast we can grow the REITs. And there comes this opportunity to for the proposed merger with ESR REIT. And with a combined platform of 5.4 billion, now we become a larger REIT and we have the scale and more flexibility to drive growth much quicker. And we can undertake a larger transaction with a larger platform. And the most interesting part of this is that we have access to the sponsor ESR Group's 50 billion new economy pipeline and 10 billion development pipeline that's in progress. So with this focus in new economy, where the sponsor has such a strong pipeline for the ESR ELOG to look at, we think that this is a very transformational merger that the unit holders can look forward to.
Yes, Karen. And Adrian, how does size matter linking with transformational and supercharging?
I think I have the same point as Karen. I think the most important part for us is that with a larger platform, we are able to actually be able to grow faster and as well as grow larger. I think both REITs has done definitely well over the last 12 months, if not 18 to 24 months, primarily because we are in the right sector, we're in the right tailwinds. It is reflected by the fact that both the share prices of ours are trading at, we're at 1.25 times book. ALOG is about 1.3, 1.35 times book. So the price to book ratio actually reflects the fact that we are in the right sector, we are doing the right stuff. But I think the tools are also there. Karen's presentation would have mentioned that with the sponsors backing, we have all the pipelines there. I think a tool overlapping REITs now coming together to have the platform to allow us to do faster, larger, and also our sponsors also has pipelines that not just logistics assets, but also has manufacturing facilities, high specs buildings that are suitable for advanced manufacturing, like life sciences, data centers. And if you look at the manufacturing sector, it is actually very robust right now. And that we have a larger platform allows us to capture that and transform two REITs who have overlapping assets, more than mid-cap to small cap, into a larger REIT that is more visible to all investors, allows us to then tap onto the whole growth profile that Karen has mentioned. Yeah.
Thanks, Adrian and Karen, for that strong tone at the top. Size does matter, transformational, supercharged. It is an opportunity of a lifetime. Let's now do a deep dive into the details, Karen and Adrian, the mechanics of the deal, the numbers, which I think unit holders are now focusing on. I have a couple of questions on exchange ratio, the issue price of ESR in terms of the shares at 51 cents. There's some question on can the deal be sweeter? So it's Chinese New Year time. Do you have sweeter goodies for us, Adrian? So let's dive into these details, and we start with Karen. Exchange ratio, how has that been computed? The unit holders like to find out.
Thanks, Wan Chen. From the moment that we received the offer from SIAS-ARA, so both sets of managers have actually sat down extensively to discuss on the proposed exchange ratio. So this is how we derive at it is also after considering several factors such as the historical trading prices of both the REITs, the market valuation of the both sides portfolio, and the most important thing is that when we look at the pricing itself, we took reference from the 52-week highest trading price. So both REITs were trading at the highest when the REITs were first included in the FTSE EPRA Nareit Index. That was sometime in
September.
Yes. Yeah. So by doing so, now we are coming to merge as a larger platform, and like what we have just discussed earlier on, coming together as a larger platform on the back of a strong unit price performance of ALOG over the last 12 to 18 months. We're now able to ride on the merits of such a transformational merger, and we will enjoy a very clear growth path with the support of the ESR sponsor, because the access to this new 50 billion new economy pipeline is the largest that any S-REIT sponsor can offer to its incumbent REITs. And also going back to the pricing a little bit, the illustrative price of 95 cents is at about 40% above our NAV. So there is already a premium that is already priced into the pricing itself. And with this premium priced in, the DPU accretion is still at the high of 8.2%, and there's also a 2.2% NAV accretion. So we have considered the commercial terms carefully, and our IFA has also opined that this is a fair and reasonable offer. Hence, we are putting forth to the unit holders, and we would like we would like to encourage our unit holders to consider the long-term growth of ELOG. And having said that, and I alluded in my presentation as well, the upside potential of future DPU accretion has not been factored in, because there are not only strong pipeline for us to look at from both our REITs operational platform, there are efficiencies that we can start to extract out of the two operating platform, and clearly economies of scale will allow us to enjoy certain savings when we run our portfolio on a combined basis.
Yeah. I must also add that this is also not an easy one for us as well, because importantly, we are paying based on the price that we are paying for, or an exchange ratio, as Karen mentioned. We are paying at a premium. Without a doubt, ALOG has done very well. The assets are in the right asset class, strong management team, have delivered for unit holders, as Karen put it out. But it's trading at 1.4 times book. Some people always ask us, so some of the unit holders ask, Adrian, who actually pays 40% premium to valuation? Now we say, guys, but these are the assets that is good. When we look at the assets, it adds onto the whole portfolio. It does the diversification. The market prices that, the 40% premium, and you have to respect what the market is saying. So that saying that. It's the same thing for us. We happen to also be trading at a premium to price book, but we are 1.2. And we have done what we believe we have done well. The market has reflected that our management team, our assets, but we are more diversified. And that is the reason why there are some sectors that may not be doing certain subsectors that may be affected more by the COVID because of especially the smaller SMEs. But at the same time, we also have business parks and high-spec space that are sought after. The space is sought after by manufacturers, and the world has changed quite a lot from US trade tensions to new manufacturing companies and trade flows that are shifting about. We are here at assets to capture that. So it was not an easy price for us to go there. It's still 1.4 times, 40% premium to NAV, and if you look at the price, this 40% premium is higher than when we first bought merged with Viva, when it was just a 30% premium. But it is what it is. Shareholders of ALOG have priced that in. We recognize that there's good value, and we are actually sort of indirectly paying for that. And more importantly, that's what Karen said, after we merged with the pro forma numbers, we found out that both REITs also are value accretive for both. Obviously, ALOG unit holders has a higher DPU accretion, is it highest? If not the highest, one of the highest. But for our side, not too bad. We also had close to about 5.8% DPU accretion. So in a way, this becomes a win-win situation for us. And we are, in a way, we are asking ALOG unit holders that I don't think you're selling out. Karen mentioned that hopefully after the merger itself, unit holders support, post-sales unit holders support us. This platform can be large and as a catalyst to actually acquire more, do more, redevelop more, as well as do more asset enhancements to make sure our portfolio becomes more advanced and most importantly, position it to be the APAC new economy REIT.
Adrian, one more question from you on the details before we go over to Karen. On the two organizations have different culture, Karen. So what are the challenges in merging the two organizations, and what can potentially go wrong? So, but back to Adrian, can the deal be sweeter?
I believe we have done what we believe we have paid what we have in terms of the pricing. It reflects what the market has also been pricing ALOG as. It takes two unit holders to bring this deal successful together. So there would probably be a little balance that need to be achieved out. I think in terms of culture, we're all similar. Karen and I have one objective, and that is that to grow and to make sure that as we grow, the returns are sustainable. And not just the returns, we also look at portfolio. Return is always associated with risk. And if we got to balance return and risk together, the philosophy doesn't change. Karen and I have been in the industry for quite a number of years, and we think that we do have the similar culture on that.
Yeah, maybe I'll just add on to
Karen.
What Adrian has just articulated. In fact, the way we run the REIT is quite similar. The asset class is within the industrial logistics sort of category. Not much. I wouldn't say that there's a lot of difference in how we look at how we extract the value out of the assets itself. And I think most importantly, by operating in Singapore, I think we have both of us have brought quite systematic and established processes to our respective REITs. And from the past track record of our REITs itself, you have seen that we have brought our REITs to its respective level through our experience in running a platform like that. So coming together, we are actually merging as two equals. So as two equals, Adrian and I are bringing in different skill sets. So from myself, I come from an operator background, and Adrian has very strong experience in the capital market fundraising. And this combined skill set and chemistry, I would say, they are very, very complementary. And we are very confident we will be able to deliver the long-term sustainable returns that we have been articulating and execute that growth plan fairly quickly for the enlarged REIT.
So for the unit holders for both REITs, it's really the best of both worlds.
Yeah.
Yes.
And that's indeed an opportunity here. So let's go down into a bit more details on the combination, the merger. There's a lot of upside, transformational, supercharged, size does matter. But what's the downside, Karen? What can possibly go wrong?
At this moment, I think a lot of discussion has been around the upcoming potential interest rate hikes. So as
the Fed is hawkish.
Yes. So in fact, for us, for the merger itself, Adrian's team has done a great job in ensuring that the funding has already been locked in. So we will not be subject to any risk of such interest rate hikes. And furthermore, both REITs has always adopted a very disciplined capital management strategy. We typically hedge our interest rates as well to avoid volatility. So that would be one area that I would think people generally worry about. It's not just us. I think general market is also concerned. The economy is recovering from the pandemic. We can see that borders are opening up. There's more inflows and outflows of goods, and generally sentiments are more positive. So if touch wood, if things turn out or go on the opposite direction, we could expect companies may sort of KIV their business expansion, and this may impact not just us, but everyone. But we believe that with more the population getting inoculated and governments across especially the markets that we are operating in, are starting to open up, we are quite confident that we will be able to still continue to deliver that growth plan for ELOG. And further, our asset class is very resilient. We are in the new economy sectors, which is what the strong demand is now.
Yeah, I think one of the key risks that I look at it is actually the hawkish Fed stance. And that was one of the first questions that even my own unit holders has asked me. The first thing is, hey, your 2.25%, $1.2 billion loan, I mean, will it still be there? Will it disappear even before your EGM starts? The answer is no, it's locked in. We got the committed lines, we have the term sheets, it's there. And it doesn't come from banks that we just met at the cafe and gave us. No, these are banks that support both SIAS-ARA and ALOG, as well as a wider ESR group as well, the relationship banks. So they know our style, they know our culture, they know how we manage things. So the numbers, so the term sheets are there. And we have always maintained a high hedging ratio, not just the hedging ratio. We're now probably about 80 to 85% hedge. After the merger, we expect to be around the same, 80 to 85. Not just the percentage, but also the hedge tenor. We don't just hedge for 6 months. No, we always have to match our hedge tenor as close as possible to our loan tenor. And that is the reason why, because we're a REIT, we're supposed to give stable is the first word, and before growing, right? So stable distribution has always be there. And capital management actually accounts for at least half of your DPU numbers, because based on the debt cost and every stuff. So this is probably the biggest risk, but I think we have managed it well. We think that it can be managed. Another risk that I probably see is cost, inflationary pressure. It may impact in cost. It may impact on the returns that we might do when we want to undertake AEI or redevelopments. And this is something that Karen and I had to sit down. If the merger happens, we've got to sit down and say, okay, we may have to maybe slow down some of the redevelopments, because redevelopments, as well as when you do AEIs, it's not just the cost risk, but also the delivery. Because not only cost has gone up, time to complete has also gone up. So we want to make sure that when our customers are most important to us, when we say that we are doing AEI, you can move in by this date, we have the confidence to deliver. Because the customer, we cannot be affecting the customer's business, ask them to. Some customers cannot work from home, so we have to be able to deliver the space for them. So I think these are the two risks that we have, that I see, as overall as a potential downside of that. But with the improving, hopefully we're in the second year of the pandemic. I always say every year that starts, things looks brighter. We hope that it looks brighter. But as I echo Karen's view, we are very lucky to be in a sector that is pretty resilient. We have the bank's support. We have our sponsors' support. We are actually taking this opportunity to capture new economy assets opportunity. New economy is not just logistics, but it's also advanced manufacturing facilities, high-spec space, business park space that can be used for higher value kind of manufacturing, as well as sectors like life sciences, pharmaceuticals, technology companies, and all.
Thanks, Adrian. As I was reading the questions from the floor, I can't but feel that I'm like a marriage counselor, the groom and the bride. So there's quite a fair bit of questions, Adrian, on the suitability of the groom. Why should we? And there's some questions on the bride, whether the bride should go for it alone and focus on logistics. You're doing well, DPU is great, and why can't you acquire new economy assets on your own? Why do you have to marry Adrian, so to speak? So maybe
Both happily married. Huh?
maybe ladies first, and then we
Yeah.
go on to Adrian, and for Adrian to portray why he's a perfect groom for this combination. So Karen, starting with you, why can't you go alone and focus on pure plain logistics and then look to acquire new economy assets? These are some of the questions on the floor.
I think first and foremost, for when I did the presentation for the unit holders earlier on, we explained the merits of this merits, MERITS, of this merger itself. It by becoming a bigger REIT, it immediately enlarges the platform. It gives us more debt headroom, especially to use debt and equity as a tool for future acquisition. So that's one. And as a larger REIT, we will also have a bigger development capacity. On ALOGS on its own, we are currently about 2 billion. If I want to take the development project, my cap is about 10% for a greenfield project, and that's about 200 million. But if once we merge as a 5.4 billion outfit, we can stretch the development limit up to 540 million. So we can see that development upside or development capacity immediately doubles once we have scale. And also as a smaller REIT, I wouldn't say it's not impossible, but if you look at the past few acquisitions in the market done by our peers, they are quite large ticket acquisitions. I think some of them even stretch up to 1.8 billion. So if we want to look at a 1 billion acquisition, for example, we may have some limitation in size to acquire such a portfolio, sizable portfolio. So by coming together as a larger REIT itself, we will have that capacity to do sizable transaction. And most importantly, we are supported by ESR Group, which is a very established sponsor, and our sponsors have the track record of providing capital commitment for acquisitions, our various acquisitions, and that is very important for a successful execution of acquisition.
What will happen before you go over to Adrian to position yourself as a perfect groom? What will happen if you stop here, Karen? Transaction doesn't occur. What would the unit holders lose out on?
I think first and foremost, based on the merits that we have articulated, we're very confident that the merits of this proposed merger is very compelling for our ALOG unit holders, because we are bringing two platforms which have the best-in-class attributes. And this merger will significantly propel our growth, and we should expect to deliver more value for our unit holders in a very long-term and sustainable manner. And then most importantly, we talk about this as a transformational merger. On our support from unit holders, one of our largest unit holder, Ivanhoe Cambridge, has actually given us the irrevocable undertaking, and that is important. It signifies the confidence from a large pension fund, established real estate player as well, that they have confidence in ALOG's growth, and hence they have given us this irrevocable undertaking. And the bigger and more liquid the REIT become, the sponsor can also do more for us. When I first started the presentation, I also mentioned that this merger will remove any potential overlapping mandates between the two REITs. If the merger is not put through, ALOG's current investment strategy will continue to be in place, of course. And we still think that the REIT has good prospect. But we do have to consider that we have certain overlapping mandate, and we'll be competing for the same pipeline from our sponsor. And I think that would not be in the interest of both REITs.
And not forgetting long-term returns.
Yeah.
Yes.
Really long-term returns. So there is a side question on Ivanhoe being potentially conflicted in terms of the voting. So maybe, Karen, you think about that while we go over to the groom.
Thanks.
Beautiful bride.
Yeah, I mean, definitely. For us, when we see the whole, for us as managers, Karen and I are always in the market. We have more data points. And one of the key data points, whether new segments of industries are coming, which are the new type of manufacturers, as well as new sectors that is like for us, for pharmaceutical, life sciences, or which are the sunset industries that's going out. I think we have a lot of data points because our customers are this sort of one. We know who are the people that's coming to this part of the world, which are the people that's exiting this part of the world, and we are there to make sure that we have the data points and come up with a strategy. Now, one of the important data points that we see is that capital, a lot of capital, especially the large fund managers, comprise capital providers, I call them, be it the sovereign wealth funds, the pension funds, the insurance funds, the asset managers. Increasingly, they're allocating more money to fewer and fewer fund managers that has sizable transactions. Their thinking is the same. Whether I have $100 million to invest, whether I invest in a $2 billion REIT or a 3.3 billion ESR REIT, the same amount of work is the same.
Or top 10 REIT.
Or the top 10 REIT, it's the same amount of work. So why not put it there? And when you put it in a larger REIT, it's much more liquid. You can get in and out much faster. Fund managers also get redemptions, and they got to take the money to spend for whatever the purposes they have set up. So liquidity is also a big point for them. So we see that as a 2 billion, a 3.3 billion, when we come in together, it allows us to capture that pool of money. That's actually the first point. And the second point is obviously like what Karen has mentioned. We have the sponsors who has given us all the tools and the ingredients, sponsors, pipelines, support of the industry, support of financial support, local teams on the various countries that we have to support. Real estate is a local game. You need your local guys to be able to manage that and all. And when we say that we have a local presence, it's not just rep office. It's a full-fledged real estate from property management, leasing, and marketing. So we have the tools from the sponsor. So by coming together, we should be harnessing the sponsor's resources to grow the REIT rather than trying to do as two separate and the sponsor cracking their head as to, okay, whose asset should go to where and how much money should I be allocating here and there, when actually, in fact, it's the most overlapping mandate. So I guess this is where the proposition of the merger actually comes well for all of us, that, coming together, we are able to capture more capital. With the more capital, the tools are there for us to acquire the assets, to manage the assets going forward. And that is why this merger makes sense a lot for both assets and unitholders.
So if I can characterize it, it's not about give and take, it's about both sides putting value on the table.
Yes.
And growing a bigger family together.
Correct. I mean, it's not just, but, lack of a better word, taking the resources of the of the family to actually grow bigger.
Yeah, and size does matter.
Yeah, size does matter. I would say 2-3 years ago, size matters. It still matters, but I would say right now, size increasingly matters. Because, as I said, fund managers are increasingly allocating more money to fewer and fewer managers that has large portfolios. Yeah.
As with any marriage, the first 100 days are important. The relationship, the coming together, getting to know the in-laws better. So we are coming to the end of the presentation. So Adrian, maybe think about your 100-day plan for this combination to be transformational, and Karen, your 100-day plan. But before that, maybe a side question on Ivanhoe.
Yeah.
Karen?
Yeah, sure. For those of you who may not know who is Ivanhoe, Ivanhoe is one of Canada's largest fund manager. They have about 70 billion in AUM under their management. So I think the question on whether Ivanhoe is conflicted, the important consideration is whether the party is a concert party or not to the offerer. And we have we have established together with ESR that Ivanhoe is not a concert party. There's no arrangement between Ivanhoe, Cambridge, and ESR such that Ivanhoe becomes a concert party. So Ivanhoe is just like any other unit holder, and they will be allowed to vote.
Okay, that's good to hear.
I think Ivanhoe, Karen, not mistaken, Ivanhoe is a pension fund, right?
Yes, it's one of the largest,
It's the largest
pension
funds
in Canada.
In Canada. I think, and pension funds actually have very strict corporate governances
Yep, true.
on that. And I would see that when Karen sort of mentioned it, when we look at Ivanhoe, because large shareholders, Wan Chen is always the first to be highlighted by lawyers and professionals to see whether, are they concert parties and not concert parties, and establish the fact. And Ivanhoe, from my point of view, is like no different from any investors. Because they're such a big fund manager and they have so much money under management, they're investing globally. They will have been invested in ALOG. They are also invested in ESR Cayman, and I'm sure they're also invested in all our so-called competitor REITs. So they're just an investor, institutional investor. In fact, we welcome them because of their strict governance, and because they are such a savvy global investor. We as fund managers, we are put on the toes to make sure that whatever we do, wherever we say we can deliver, and that we are delivering at the right returns and risk. Yeah.
Okay, thanks, Aidan. So ladies first, 100-day plan for a productive combination, greater yield, greater dividends, greater DPUs, more opportunities, more babies, more children.
Yes.
So maybe Karen, your 100-day plan, then we will wrap up with Adrian.
Sure. Okay, I think 100 days is really like 3 months, 3.5 months or so. It's not a very long runway. So the key important first task we need to sit down and discuss is the integration of the teams and
it's a merger of equals.
Yes.
That's correct. And the integration of the operational platform. While we operate on a very similar basis, we do have some differences in our processes. We just got to iron it out. The most important is that when we look at some of this integration, how we can make our systems and processes more efficient, how we can extract more value out of the portfolio when it's combined. And most importantly is there will be no disruption to our tenants because of this merger. So business will be as usual. And when the two teams comes together, we bring across different skill sets, and both Adrian and I will look at our team and harness their capabilities so that we can work together as a combined team to deliver what we have articulated in our strategy.
Mm-hmm. So it won't be a long wait. It won't be 10 years.
No, I don't think so, because both our REITs are very similar. We operate in the same platform. Mm-hmm. Obviously, I would say if you ask me if there's any commonality, is probably close to 80-85%. There's common. The way how we review assets, how we run assets, how we collect money from tenants, which is the most important thing. Yeah, it is. What I would think a lot of focus on the first 30 days is obvious integration, but it's not something that's a deal breaker. Things like accounting principles, we have to make sure that's there. As Karen said, tenants needs to continue to run. When they pick up the call, got to make sure that the same guys is still there to answer the question, to clear the rubbish bins and all this. So this will still be there. What we go to focus integration, really more the systems, financial systems, property management systems, accounting principles, to make sure that we can still continue to report our results so that we can still pay dividends on time. So that is what. Then after that, immediately, as I said earlier, we got to look at the growth plans. We have those assets. We know that it's suitable for us. We know what kind of returns that we can get. Start planning for that, the assets. And then obviously the last one is actually to sit down together and see where we harness the synergies from the economies of scales and all. So I think we have our hands full
In the first 100 days.
The first 100 days, but it's not something that is a rocket science. Maybe I'm a little bit in an advantage situation whereby I have done a merger 3 years ago. Similar sector. That would be the good part of this merger is that we are not merging with people from different sector. A hotel merging with a hospital per se. You know, that would be like quite totally different, right? Different culture, different stuff, but we are in the same sector. We are in the same subsector of industrial, and yeah. So I think, while yes, a lot of things for us to do, but it's not something that's insurmountable. I think unit holders of both ESR REIT and ALOG should be confident that we will get you'll get your distribution on time. That's for sure. And things will get, and we were very eager to actually execute our plans, our growth plans. Yeah.
Okay, thanks, Adrian. So if I can summarize it, and after this, Karen, please do have the opportunity to summarize, and Adrian, about this combination, this merger that's transformational, supercharged, and size does matter kind of opportunity. So if I can summarize it, is DPU accretive immediately, strong pipeline from the parent, $50 billion, two immediately, $2 billion in the pipeline. There is low-hanging fruits. It's a culture, so it's a similar. You have a 100-day plan, bring value to the table. So it's something that is an opportunity that should not be missed. So maybe Karen, final words from you, how you sum up for your unit holders?
Yep, sure. So for this proposed merger itself, this is really a transformational merger for our ALOG unit holders. And I first and foremost, again, I would like to thank our unit holders for your support all this while. And we do hope that you'll continue to support us in the enlarged REIT, because we believe in the merits of the merger, such as becoming together. Size does matter, as we have been discussing quite extensively. Once we have that scale, we have a lot of flexibility to undertake sizable transactions. We can do more larger AEIs, and also potentially look at expanding across these growing markets beyond Singapore and Australia, and expand our footprint. And all this would be possible because we have now a very strong sponsor supporting us. So in a nutshell, I think having a larger REIT that also comes with other benefits, like we can extract economies of scale from the operating platform. And we also believe that with a larger REIT, we will be able to also access to more capital, good sources of capital, and possibly more competitive cost of capital. And both of our REITs are currently in the FTSE EPRA REIT index. And we believe that once we come together, being in a larger size, there will be more weightage given to us. And we certainly will attract more institutional investors' interest. And this could lead to potential re-rating. So there's quite a lot of benefits and merits to this merger itself. And more importantly, the offer allows our ALOG unit holders to roll over to the enlarged platform and continue to enjoy the potential upside. And yet at the same time, you'll still be able to crystallize some of your returns in cash. So we hope that you will support us in the upcoming EGM. Thank you.
So for ALOG unit holders, it's transformational, it's supercharged, both parties bringing value to the table. Adrian?
Yeah, I think what I will add as a closing remark is that there's been a paradigm shift in the last 2 years. The way we produce goods, the way we consume goods, and the way we deliver goods has actually changed a lot. The geopolitical risk is still there. You have trade tensions and going around. So the world has changed. But we are in the right sector. Both REITs are in the right sector. By coming together, we now have the platform. We are asking unit holders of both REITs to support us because we have the overall macro environment. We are in the right sector. We have the tools from the sponsors to be there to support us. So what we ask for unit holders is to allow us to have a larger platform so that we can actually deliver faster as well as a larger and establish ourselves as one of the leading Asia-Pacific new economy once the merger is approved for us.
Maybe just one point to add.
Go
This
ahead, Karen.
transaction is immediately DPU accretive at 8.2% to our unit holders and 2.2% NAV accretive to our unit holders. So you can see that the potential accretion is there. And we certainly, Adrian and I certainly look forward to work hard together and deliver even better returns for our unit holders.
Well, we're coming into the last few seconds of the session. One final word, one word if you can leave behind with our unit holders from A-Log, Karen, what's the one word that you leave behind for them to think about for this opportunity?
I think of this as a transformational journey. And you have seen how we have re-rate A-Log in the past 12 to 18 months. And with the merits that's backing this transaction, we are confident that we can transform E-Log into a new economy APAC as REIT and become one of the established large as REIT that you'll be proud of.
Top 10.
Yeah.
Adrian,
Yes.
one last word.
Well, the same word, transformational.
Transformational.
It's transformational. I truly believe in these words, and we are, as I said, the sector is in our favor. The market trade flows are in our favor. Sponsor is there. Ingredients are there. So we just need the platform to crystallize the word transformation.
Thank you very much, Adrian and
Thank
Karen.
you.
Thank you very
Thank
much
you
for
very
your
much.
Thank you,
input
Wan
and
Chen.
your sharing with the unit holders. And with that, A-Log unit holders, we've come to the end of the SIAS-ARA virtual dialogue session. We thank you for your time. As always, both organizations are open up to questions from now to the 27th of January for the EGM. And with that, stay safe, have a good weekend, and talk to you soon.
Thank you.
Thank you very much. Thank you.